We've got a head and shoulders pattern, very bearish, that is confirmed in the stock market here this past week. We've been watching it on the Nasdaq 100. It's been slowly developing. This is a pattern that goes all the way back to August of last year. And now it's confirmed with a 1.6% sell-off this past week in the index. We're going to get to the charts real quickly here, but first, make sure you pound that like button and click subscribe so that you're a part of my YouTube channel, as well as clicking the join button down below so you can become part of my YouTube membership, where you'll get all my stock market research each and every day. Now, to those charts, we have the QQQ. Again, this is the Nasdaq 100. These are a lot of your big tech stocks right here, like Apple, Amazon, Google. Huge influence on these because you're only talking about 100 stocks here. So their weight on this index is huge. But check this out, guys. Big left shoulder, head, and right shoulder. Now, where does the neckline come into play? Well, when we zoom in, I draw my neckline right here. It connects multiple points here. And it also, this is a little bit of a messy area here going back to January and early February where we bounced. But for the most part, it held this level here, came back down, retested it, bounced again. And now it has failed to hold that support level and it's trading just below it. When you look at it in the grand scheme of things, this could be a major topping pattern in the market. And beyond the Ukraine situation with Russia, you have the stock market that is on the wrong side of the Federal Reserve right now. Unless the Federal Reserve caves and decides to get dovish again once the market starts to crater, I don't see the Nasdaq or the other indices for that matter going anywhere but lower. Now, again, is this a conviction, confirmation? No. We need follow through this upcoming week to confirm that this head and shoulders is in place, because oftentimes what you'll see happen is it'll get just below the neckline, or it'll test the neckline and it'll bounce higher, sometimes going all the way back up to all-time highs. Let's look at a couple examples here. I'm going to look at a double top from 2018 and a head and shoulders pattern from 2017. First off, this double top pattern did exactly what I was just telling you about. A lot of people got bearish about this double top pattern that was forming back in 2017 and 2018. It went all the way down, tried to confirm it. But in a matter of months, the Nasdaq 100 was back to trading at its all-time highs. Okay, now let's go back to 2017, just about a year earlier. You had a notable head and shoulders pattern forming. Now, it's nowhere near the size of the head and shoulders pattern that has formed over the past 7 to 8 months on the Nasdaq 100, but this was still quite the pattern, and it had a lot of people very nervous. And when this chart confirmed, it went down just a little bit before rallying right back up into the all-time highs. So let's zoom back to present day. Massive head and shoulders pattern. We're just starting to confirm this pattern, but we need more follow through to the downside just to make sure. It doesn't mean that you can't play it to the short side, but be very, very aware of the fact that this could bounce back against us, as we've seen many times in the past. The big difference in this pattern, though, is that the Fed is on the other side of the stock market. After the month of February, it's no longer going to be buying assets and adding to their balance sheet. It's no longer going to be keeping interest rates at zero. In fact, it may even do a 50-point rate hike at the next FOMC meeting. So considering the backdrop, don't even worry about the Ukraine and Russia thing. Yes, that's weighing on the market right now. But going beyond that, you have this massive head and shoulders pattern with the Federal Reserve that's trying to fight inflation. And the only way to do that is by raising interest rates. One of the major reasons why these patterns didn't materialize in the past is because the Fed was still accommodating during those times. Now, zooming out a little bit further here, let's look at this 200-week moving average. This has been a fascinating level to watch because at multiple points of where we had significant pullbacks in the market, like what we saw in 2018 and Q4, and like what we saw during the COVID sell-off in 2020, this 200-week moving average has never been broken. You can see here again, Q4 2018 gets just above it before it finally bounces, and then 2020, it tests it and immediately sparks one of the greatest rallies in market history, at least for the indices, because they were supported so much by the FANG stocks. But you can go back to 2015 too, and you're going to see another pullback to this 200-week moving average that held and bounced. So what do I think? I actually think that we're going to see a pullback to this 200-week moving average at some point this year. I don't see it necessarily happening the next trading session or the next week. That would be a pretty significant move for that to happen. Not impossible, but very unlikely. And right now, this moving average is moving up at about $1 a clip per week. So each week that goes by without it testing it, that moving average is pushing higher because it's below the current price action. Now, in the two instances where it doesn't happen is the biggest recessions that most of us have ever seen in the stock market. The first one being 2008, where we crushed right below this. And then you go all the way back to 2000, when the dot-com bubble blew up, and we go well below it, okay? In the grand scheme of things, we can zoom out and get a better understanding for what this looks like. Again, 2000, 2008. Those recessions, we break below the 200 moving average. The times where we didn't, 2015, 2018, and then fast forward to 2020. So that's going to be a very important price level to watch in the weeks and months ahead, because the depths of this pullback, what inflation does to the economy, is going to ultimately result in whether or not we hold this 200-week moving average or not. The last 3 times we have. But when things get really out of hand, when valuations get really crazy, that's when we start breaking below this 200-week moving average, and then all bets are off. Last chart I want to show you here is the Nasdaq 100 from the yearly standpoint. Now let's say we're taking a tamer view of the Nasdaq 100. It's not going to be that bad. Notice on this chart here, following COVID, when we were injecting the economy with just helicopter money, just tons and tons of free money, what did the market do? It went straight up. More people got involved in the market than ever before. This went completely parabolic. But prior to that, almost in every situation, we test this 5-year moving average in the market. Sometimes we go below it, but most of the time we test it and finish above it. Now, the times that we don't, like what we saw here in 2018, when we get significantly above it, it does result in a notable pullback. And so right now, we've already pulled back a lot this year, but it stands to reason we're going to come back and test this 5-year moving average right here that currently sits at 283.83 on the Nasdaq. If that's going to hit, and history suggests that the market will pull back to this 5-year moving average, we have another 17% of further downside at some point this year before we ultimately put a bottom in and bounce. That would result in a 29% decline from last year's close to this moving average here. So yes, there's a lot of potential downside left in this market. And my reason for telling you about all of this is to make you prepared for what could happen in the stock market over the course of the next 10 months. The S&P 500, the Nasdaq 100, the Russell 2000, they're on the wrong side of the Federal Reserve's monetary policy right now. And when that happens, you hear about the whole idea of don't fight the Fed. Well, the market's in a situation where it may have no choice with the rising interest rates and inflation to go lower. And so you want to make sure that you're protecting your profits along the way. You're wanting to make sure that if you do get in a long setup that doesn't work out because the market starts to fall apart again, that you're not holding it all the way down to the bottom and taking some major losses because you emotionally weren't prepared to take on those kinds of risks as it pertains to the stock market as a whole. If you enjoyed this video, please make sure, once again, to pound that like button and hit subscribe to help me continue to grow this channel. Let me know down in the comments, what kind of questions do you have about the stock market? Are you worried? Are you fearful? Let me know. I'd love to engage you guys on all of this in the comment section down below. Thank you guys, and God bless.